There is a shock wave moving through the economy right now, and most people cannot see it because the headlines are telling them the crisis is over. If it is over, then why are construction companies still losing money on jobs they already signed? Why are trucking fuel surcharges still higher than before and not falling back into place? Why is the home building complex still acting like something is badly wrong even after the ceasefire language hit the news? That is what interests me, because I have learned over a long lifetime around money that the real danger often begins right after the headlines say the danger has passed. That is when ordinary people relax. That is when the financial consequences are still moving quietly through contracts, margins, supply chains, and balance sheets. That is when the people who only follow surface news get blindsided. So let me explain what I think is happening. The easiest way to understand this is to go back to the start of the shock. Tensions with Iran escalated. Brent crude surged violently. Then later, after the ceasefire language arrived, oil pulled back off the panic highs. Most people looked at that chart and assumed the story had ended. Oil went up. Oil came down, crisis over. That is how people think. If they believe markets work like light switches, but the economy does not work like that. The economy works more like plumbing. Pressure hits one end of the system, then it moves through the pipes, and by the time the pressure reaches the kitchen tap, the people in the house no longer remember what happened at the water main. That is exactly what an oil shock does. When oil spiked, every trucking company, every shipping company, every business moving goods had to reprice fuel surcharges immediately. They had no choice. Fuel is not some decorative expense for them. It is one of the major inputs that makes the machine run. So the surcharges went up fast. And here's the part the average person misses. They do not come back down just because the commodity price backs off temporarily. They are sticky. That is one of the dirtiest truths in economics. Costs move up fast and come down slowly, if they come down at all. So now what happened? Those higher transport costs hit manufacturers. Manufacturers had already signed contracts at older prices. They could not magically turn around and demand more money on the same terms the next day. So they absorbed the loss when businesses absorb higher costs under fixed price arrangements. What gets hit first? Margins. And when margins get hit, the damage does not disappear. It gets pushed forward to the next pricing cycle. That means the inflation you feel months from now is often already sitting inside contracts signed today. That is why I keep saying the shock is already in the system. Nowhere is that clearer than construction. Construction is the place where this sort of shock becomes brutally visible. If you know where to look, a contractor signs a fixed bid job, then materials move, transport costs move, labor pressure remains. Financing stays expensive. The contract, however, is still the contract. You do not get to walk back into the room and say, lumber went up, fuel went up, I need more. Sometimes you can renegotiate around the edges. A lot of times you cannot. So the contractor eats it. And if enough of that happens across enough projects, then you get something very dangerous. You get businesses that are still busy but are losing money, busy and bleeding. That is a miserable place to be. That is why I care so much about home building and construction. Related signals here. They tell you whether the shock has been absorbed or merely transferred. Right now, I do not think it has been absorbed. I think it has merely been transferred. That is the shock wave. Energy reprices transport. Transport reprices manufacturing. Manufacturing reprices construction. Construction reprices housing. Housing eventually reprices the cost of living. And by the time the ordinary consumer fully feels it, the process has already been moving for months. That is why I do not find the crisis is over language persuasive. Ending the shooting does not reverse the pricing pipeline. It can prevent the next shock from getting bigger. That is useful, but it does not undo what is already lodged in the system. Now let me explain why this becomes such a problem for the Federal Reserve, because once this kind of inflation gets moving, the Fed ends up trapped in one of the oldest and ugliest dilemmas in finance. The Fed really has one major tool, the price of money. Raise rates, and you slow things down. Cut rates, and you try to encourage activity. Simple enough when the world is behaving. Not so simple when inflation and economic weakness start arriving together. That is where we are getting uncomfortably close. Door number one is to raise rates. That is the orthodox answer. If inflation is the problem, make money more expensive, slow demand, cool things off. Fine, but look at the type of inflation we are talking about here. This is not simply people out partying too hard and bidding up restaurant tabs. This is a shock moving through fuel, freight, manufacturing input costs, and fixed price contractual structures. It is sticky supply side margin, crushing inflation. If the Fed raises rates into that, what happens? It does not magically fix the contractor who is already underwater on signed jobs. It does not restore the margin of the manufacturer who got trapped in old contracts with new costs. It does not cure the trucking company whose costs were repriced faster than its customer relationships can adjust. What it does do is increase borrowing costs on top of an economy already dealing with cost pressure. That is how you push a slowing system toward recession. So door number one fights inflation by making an already damaged economy weaker. Door number two is the alternative. Hold steady, cut later. Ease when things break. In other words, support growth. That sounds nicer politically, because recessions make headlines in ways inflation usually does not. But door number two comes with its own poison. If you hold rates too low or cut too soon, while this shock is still moving through the system, then inflation keeps running hotter. The dollar loses purchasing power faster. Every fixed salary, every cash balance, every nominal promise buys less. That is the other side of the trap, and if you watch enough central bank behavior over enough decades, you see the same pattern again and again when forced to choose between clean purchasing power and avoiding visible recession pain. Policymakers usually choose the inflationary route. They choose the slower theft over the faster collapse. Why? Because recession gets blamed quickly. Inflation is easier to disguise, rename, externalize, and soften with language. It gets blamed on oil, on geopolitics, on greedy companies, on weather, on anything except the monetary and policy structure itself. That is the principal agent problem at work. The public is the principal. It is your money, your retirement, your purchasing power. The Fed is the agent, but the agent's incentives are not the same as yours. Your incentive is to preserve real value. Their incentive is to avoid the outcome that explodes visibly on their watch. Those are not the same objective. So when I ask which door they are more likely to choose, I do not ask the question morally. I ask it structurally. And structurally, they almost always drift toward door number two. More support, more accommodation, more money creation, more debasement. Not because it is noble, because it is politically easier than taking the recession pain cleanly and immediately. That is where this shock stops being only about oil and starts becoming about the entire monetary system. Once the Fed is pushed toward that, you get a second shock wave. The first wave was physical, energy into transport, into manufacturing, into construction, into housing. The second wave is monetary support, liquidity, money creation, and that second wave does not hit every asset the same way. This is where the market splits. One side gets hurt by the shock first. The other side eventually benefits from the policy response to the shock. That split is the entire game. Let us start with stocks. A stock is a claim on future earnings. That is what it is at the most basic level. You can decorate it however you like. Story, narrative, sector trend. But underneath all of that, a stock is a claim on a company's future profits. Now, what happens to those profits during the first shock wave? They get damaged. The contractor loses money on fixed bids. The manufacturer gets squeezed by higher input costs. The retailer absorbs more expensive freight. Margins compress. Earnings estimates fall. That damage is happening before the Fed response fully arrives. That timing matters enormously. Because by the time the policy rescue comes, the businesses themselves may already be wounded. Cheaper money later does not reverse every loss that has already been taken. It does not repair every contract that was signed at the wrong price. It does not put old margins back in place like magic. That is why stocks can struggle badly in this phase. Not because money printing never helps risk assets. It usually does help eventually. But because the fundamental damage arrives first and the rescue arrives later. And even when the rescue arrives, it often only partially offsets the business damage already done. That is why I think a lot of equity investors are misreading this setup. They see easing on the horizon and assume that alone is enough. It is not always enough. If the earnings engine is taking body blows at the same time, stocks can still have a very ugly stretch before the monetary tide lifts them again. That is what makes this stage so deceptive. Now let us compare that with Bitcoin. Bitcoin has no income statement, no margins, no payroll, no trucking surcharge, no supply chain, no fixed bid construction contract, no quarterly earnings disappointment in the usual corporate sense. It is not a business that must absorb the inflation shock and then wait for the Fed to try to fix the damage. It sits outside that chain. That is why I think the distinction here is so important. The same shockwave that hurts corporate fundamentals is the same shockwave that eventually pushes the Fed toward more accommodation. And that accommodation hits monetary assets differently than it hits operating businesses. Once the system moves towards support and liquidity expansion, the newly created money does not have to pass through a damaged operating company to reach Bitcoin. There is no corporate middleman. There is no margin repair process required. There is only a scarce asset with fixed supply sitting there absorbing liquidity directly. That is the mechanism. The shock wave is bearish for one side of the market and eventually bullish for the other. That is not a contradiction. That is structure. Now, I know a lot of people get uneasy when this conversation turns to Bitcoin because they think the whole thing is ideology. I do not care about ideology here. I care about behavior under monetary stress. And what interests me most is not memes or slogans. It is the historical setup. One of the most interesting ways to look at Bitcoin is through its rolling 2-year returns. In all of Bitcoin's history, that measure has gone negative only a handful of times. That matters because those moments have tended to be the periods when the market has completely lost confidence and long-term opportunity quietly becomes extraordinary. After prior collapses, the same script played out: public disgust, media contempt, people declaring it dead again, then a long, powerful repricing upward. Not every time in exactly the same shape, but the pattern is there. And what is striking in the current setup is that the rolling return pressure has reappeared again, while the institutional structure underneath Bitcoin is much stronger than in prior cycles. That matters to me because past episodes happened when the buyer base was shallower, weaker, more retail dependent, and easier to shake out. Now you have ETFs. Large institutional flows, corporate treasury demand, sovereign level curiosity, a much deeper ownership base than before. So the structure beneath the price is changing even as the setup resembles prior accumulation zones. That is not trivial. That is why I do not look at this merely as another speculative swing. I look at it as a scarce monetary asset sitting on the favorable side of a policy response the Fed is extremely likely to make once the economic damage becomes impossible to ignore. And that brings us full circle. The contractor who loses money on a signed job, the trucker whose costs got repriced, the manufacturer whose margins got hit, the retailer whose freight bill rose, the home builder whose index still looks sick after the ceasefire. All of that is the first shock wave. Then the Fed gets trapped, fight inflation and crush the economy harder, or protect the economy and debase the currency faster. Historically, they choose the second route. That produces the second shock wave. And when that second shock wave arrives, you do not want to be stuck only in the assets that were structurally damaged by the first one. That is the whole point. Now, I am not telling anybody to go all in on one asset. That would be foolish. I am telling you to understand the map. There are times when the same macro event punishes different asset classes in radically different ways. This is one of those times. If you own traditional equities, you have to respect the earnings damage. If you own scarce monetary assets, you have to recognize that the coming response may work in your favor. in a much more direct way. That is, the split. That is why I think this moment matters so much. And it is also why I think people who keep waiting for clean, universally bullish conditions are likely to miss the whole thing. The setup never feels clean. It never comes gift. It looks like confusion. It looks like one part of the market breaking, while another part quietly prepares to absorb the response. That is exactly what is happening now. If you ask me for the plain version, it is this. The shockwave started with energy. It moved through transport, manufacturing, construction, housing, and corporate margins. That creates the Fed trap. The Fed, in my view, is far more likely to choose the path of inflation and support than the path of clean recessionary pain. That policy response is bad for damaged earnings assets in the early phase and favorable for scarce monetary assets that do not depend on corporate cash flow to justify themselves. That is why I think this is one of the clearest macro splits in the market right now. One side gets hit by the body blow. The other side benefits from the medicine. And the only real question left is whether you are positioned on the side that takes the damage first or the side that absorbs the liquidity after the damage has already forced the response. That is the choice. Because the shock wave is already here. The only thing most people are still debating is whether they believe it.